See, markets are going to always remain uncertain. Our job is not to kind of predict every twist and turn, but our job is to kind of build a model which can keep adapting to market situations.
No, it all makes sense when you tailor everything together, and it helps to generate what we call about alpha.
What they're generally looking for is, can I get an investment which gives me certain consistency? If the portfolio can kind of rebalance, adjust, adapt to market conditions at that point of time, there is a possibility that you can actually have a better outcome.
Hello and welcome to ET Podcast. Well, my name is Kshitij Anand, and for decades, investment has been largely relied on the wisdom, knowledge, and the instincts of the fund manager. But cut to 2026, things are pretty different thanks to technology, data science, as well as quantitative methodologies. Now, in fact, our today's guest comes from India's leading quantitative investment firms, AlphaGrep, which manages close to $1 billion across asset management businesses globally. In fact, AlphaGrep is now bringing in the quantitative methodologies to the mutual fund industry. In fact, to discuss this more, we have with us Bhautik Ambani, who's the CEO of AlphaGrep. Let's welcome him on this very podcast. Hi Bhautik.
Hi Kshitij, good to see you.
Welcome to the ET Podcast.
Thank you so much for coming here.
Great. So tell us about the idea of AlphaGrep.
See Kshitij, the way we think about it, we think markets is actually more like a data problem, right? And which at AlphaGrep as a philosophy, what we are trying to solve for is, how do we solve for this data issue by improving probabilities of investing in the market?
Right.
And that's exactly what the firm has been now doing for close to 16 years. That's exactly what we are now trying to bring it to retail investors as well.
Absolutely. And in fact, bringing the quantitative science to the mutual fund industry, it's a very interesting idea.
Yes. We are excited about it. We've done that for ourselves for a large part of the 16 years. We've extended that to institutions, corporates, family offices over the last 4 years. And now we're excited to bring that to retail.
Absolutely. Well, on that note, let's dig deeper on this idea more.
Sure. Looking forward to that.
Absolutely.
Thanks.
Thank you, Bhautik, for joining me on this ET podcast.
My pleasure.
Well, to start off with, Bhautik, let me understand the current dynamics of the markets at this point in time. We are seeing geopolitical tensions. We are seeing some tariff tantrums as well. And, some of these things have not been died down in the past 3-4 years and still continuing. So why multi-asset fund at this point in time?
So see, the way I look at this is that I don't think investors kind of wake up every day thinking, I want to invest in equities, I want to invest in gold, or should I be investing in fixed income today?
Yes.
Right? What they're generally looking for is, can I get an investment which gives me certain consistency and reduces my anxiety, right? And which is exactly why what we thought was that, why should an investor just rely on one asset class to make money for them, right? And hence, a multi-asset product actually gives all three asset classes enough and more opportunity to kind of perform, create consistency, create stability for an investor's portfolio, right? And that's exactly the reason why we thought of multi-asset.
Absolutely. In fact, when we're talking about multi-asset, we've seen how gold has behaved, and it got a lot of glitter to the investors, especially for the past 2 odd years. Outshined equity markets per se, and the other asset classes are, we are seeing some bit of traction in the US Treasury bond yields as well, and that is also coming as a threat because whenever US bond yields sort of inches up, it moves a lot of money from equity markets to the Treasury bond yields. But that's apart. How does the model sort of behaves in any market crisis?
Sure. So what we've done, Kshitij, is that we've kind of broken down the last 20 years over like broadly 12 economic cycles, okay, that India has witnessed. And it's, when I say economic cycles, these are shorter cycles. Like for example, GFC happened in 2008-9, so that was a couple of years. Then we took a couple of years to kind of recover from that. Then you had 2011 when you had the Eurozone crisis. Then you had the taper tantrum. Then you had the IL&FS crisis. So broadly, as per our data, it kind of breaks down into around 12 economic cycles. Okay, and then we looked at the performance of broadly 3 asset classes: equity, so Nifty. We took gold as a proxy for commodities, and then we took fixed income. What we've seen is that in only 50% of the times, or 6 out of 12 cycles, has equity outperformed the other 2 asset classes. And the balanced 50% of the times is actually commodities, which has done better. So contrary to our perception that gold has done well only in the last couple of years, because obviously we've seen an outsized rally in the last couple of years, it's actually, there have been multiple other periods where commodities done well or outperform fixed or outperform equities, right? Which means that, so 2 things here. One is, why rely on only one asset class to do the job for us? That's point number 1. Point number 2 is that at times when equities has not done well, it's gone through deep corrections. So which means that if there are periods when, let's say, equity risk is going up, if the portfolio can kind of rebalance, adjust, adapt to market conditions at that point of time, there is a possibility that you can actually have a better outcome, right, by having more stability in the portfolio, by having less exposure to equities at that point in time.
And for the quant, the methodology that you're talking about requires a frequent rebalancing, and that also sort of inches the transaction cost. So how does that really come up in the portfolio?
Sure. So see, there is this perception that just because it's quant, do we need to trade, right? So the idea out here is not that we are forced to trade or do we need to trade, at a certain point in time. It's just that whenever the model is kind of, giving us a signal to readjust, to trade, to take a certain decision, the decision is based on a certain, thesis at the back end or a logic at the back end, right? Which is asking us to trade. So A, it's not about forcibly trading. B, if there is a rationale or for a reason for us to trade, then we would rather do that.
So is there a different strategy whenever you are rebalancing?
Think of a layman investor who is not glued to the markets, who is, not, kind of tracking the markets on day-to-day basis. Is there a possibility for them to be looking at some of these variables or a lot of these variables on a day-to-day basis? The answer is no.
Answer is no, yes.
Right? So what we are trying to do in this fund, to a certain extent, is that, see, in our case, so if you look at the construct of the fund, in our case, equities and fixed income have a wide range where we can actually take down the exposure to take the exposure to a high level. So for example, our equities and fixed income can go down to as low as 10% net exposure to a 60%. And commodities can go from a 10% to a 40%. That's point number 1. 2 is that it's just not about having the flexibility. When we've kind of tested this or backtested this for the last 20 years, because it's a quantitative model, and we just didn't test it for 5 years or 10 years. We actually wanted to test it for 20 years so that we get more economic cycles and see, what the outcome is of the model. In this 20-year period, in different periods, our model has actually used these ranges. So to give you an example, there was a year where between 2008 and 9, our equity exposure in the model was as low as 11% at the lowest point, and within a year, it scaled up to 55%. Right? It's a sharp increase. We've seen another month where from one month to another month, the equity allocation moved up by almost 20% in a single month. Now I'll tell you why does this happen. See, in our case, the models that we have developed and we are deploying, and again, none of these models are new to AlphaGrep, because as a firm, we trade multiple asset classes, we trade multiple countries, and we've been doing that for close to 16 years now as a firm, right? So the experience, exposure is there. So what we've done is that in our case, the models are more statistical. And when I say more statistical, what they're doing is that these are cross-asset models. What that basically means is that it doesn't look at one asset class in isolation or look at valuations on equity and decide saying that, oh, based on equity valuations, I'm going to decide on the exposure for the entire fund. Okay, because you have two other asset classes which are not necessarily behaving in the same way as equities, and neither are equity valuations deciding for where gold prices should be, or any other commodity price should be, or fixed income should be, right? So in our case, these are statistical models, okay, which are a combination of something what we call risk parity, sharp optimization, and these are cross-asset models, which look at all three asset classes as one, kind of packaged,
together, right?
right? And within that package, it keeps doing rebalancing based on multiple parameters. And because it's statistical, we are looking at relatively shorter term data, and we are able to dynamically adjust exposures and adapt to market conditions at a much faster clip. So for example, in our case, the asset allocation rebalancing happens on a weekly basis.
Multi-asset fund, where does it fit in investors' portfolio at this point in time, considering the fact that there are also a lot of other multi-asset funds there?
Yeah. So we looked at the industry, okay, of multi-asset funds. When we looked at the industry, what we realized was that, and we kind of looked at the data of the last 5 years, and we put all the multi-asset funds together, and what we realized were two things. One is, out of 100 rupees, broadly on an average at industry level, 55 to 60% is invested in equities. Okay, so which means that we are largely relying on that one asset class to do the job for us.
Exactly, to do the heavy lifting.
Exactly.
That's what we say.
Yes. So that's point number one.
Okay.
The second point is that, again, when we looked at the last 5-year chart, what we also realized was that broadly the allocations, exposure allocations, let's say 55 to 60% to equities, 20-25% to debt, and a small token exposure to commodities around 10-15%, that's largely constant. Okay, and hardly moving around by like 5-7%. Okay, so two things that we realize from this data. One is that most funds are relying on equities to do the job, and two, the exposures, irrespective of market conditions, right, are remaining pretty much constant. What we believe in is that what we just discussed, the historical correlations can break, right? Second thing that we believe in is that it's just not one asset class which is necessarily going to perform in all market situations. Okay, which means that you got to kind of rebalance your portfolio basis what's happening in the market, right? When you think about the scenario, like for example, somebody who invested in the markets 4 years back, or 5 years back, till 2 years back, till let's say 2024, was looking at very different IRRs in their portfolio, okay, versus what they're seeing today.
Right.
Okay,
Something is amiss, and that's the return part.
Yes. Now imagine at that point of time, if there was a model which could adjust your exposure, take some money off the table from equities, put it into some other asset class, would the IRR look better or not today?
Absolutely, it looks better. It looked better.
So what we're saying is that in our case, the model has been built around such a way that it keeps adapting to the market scenarios and keeps readjusting exposure. So coming back to your point, how should an investor think of this? In our view, this can actually work like a core allocation for an investor. Okay, because what it gives you is, it has exposure to equities, which is that growth engine. It has exposure to fixed income, which gives you the stability and the income generating aspect to it. And it has gold or commodities. In fact, the other thing I want to mention is, in our case, in commodities, we are not going to be only restricted to gold or silver. We are also going to be taking exposure to crude and copper.
Right.
Okay. So exposures across 4 commodities, which is generally again something that we've not seen across most other funds. So we are allowing our fund to take that exposure.
Copper has also picked up recently. Yes.
Yeah. And the other thing is that in our case, so even though the asset allocation rebalancing is weekly, the stock selection rebalancing, again, that's a multi-factor model which allows you to do that. And the commodity rebalancing, which is across these 4 commodities, that happens on a daily basis. Now, if you think about it, in March, the war broke out in the middle of the month. I would have waited till the end of the month to do anything on that.
Yeah, I mean, that would not
to act on it.
Yeah, absolutely.
Right. So in our so the way we are looking at things is that I am getting data on a day-to-day basis. The world is dynamic. Why should I wait out for a longer period of time if I can act faster? When you look at the last 20 years, and again, we're not benchmarking ourselves to equity or Nifty, but for reference, let me tell you, how this looks versus, let's say, taking a pure equity exposure. So had somebody taken a pure equity exposure with Nifty over the last 20 years, from 2007 to now, they would be broadly looking at around 11.5% CAGR, compounded return. Now, to get that 11.5% compounded return, let's also look at what risk did we take as an investor. So from a risk perspective, let's look at two aspects. One is volatility of returns. Second is drawdowns. From a vol perspective, Nifty has attracted a vol of around annualized 20% over the last 20 years to make 11.5% compound return. And the peak drawdown from the highest to the lowest point that we've seen in Nifty in this period was around 60%.
Okay.
60.
60.
Okay. Now, let's also look at, let's say if I was running a static asset allocation, where let's say out of 100 rupees, I put 60 in Nifty, 25 in fixed income, 15 in gold, and just rebalance that on a monthly basis. What would numbers look like in that case? That would have given me a 9.5% compounded with a wall of 12.5 and a peak drawdown of 40%. Now let's look at our results where we kind of combine both the layers. So one is the asset allocation engine, which itself kind of helps us generate alpha. And the second is a security selection engine, which is picking the right stocks.
More dynamic.
Yeah, the dynamic approach, both on asset allocation plus stock selection plus commodity selection, right? You combine that. Over the last 20 years, what that has yielded for us, or what's showing, is a compounded return of 14%.
Okay.
Okay, this is after adjusting for fees and everything.
Okay, that's a CAGR of 14 plus.
14% over the last 20 years.
Okay.
But what is more important is risk.
Right.
Or what it's doing to risk. 14% return with a wall of around 7.5%.
Oh, okay.
Less than half or almost a third of what you've seen in Nifty.
In Nifty, yes, absolutely.
Okay.
Yeah.
And a peak drawdown of around 13.5%.
13.
13.
3.
Yes.
Okay, from 60
to 13.
to 13.
So you're not only looking at better returns, right? You're also looking at a much better risk profile.
Let me also, get your perspective on the fact that, you did mention $1 billion
Yes.
in across asset management businesses
Yes.
globally.
Yes.
How does the infrastructure risk management look like for AlphaGrep?
Yeah. So obviously all of this has got built over a period of time. So if you see, so my colleagues are the two co-founders of AlphaGrep. So Mohit Mutreja, Prashant Mittal. Both of them come from a very similar kind of background. So both of them are Wharton pass outs. After passing out, got like an experience of working in some very large quantitative funds at a global level. Right? So they worked with firms like Citadel, AQR, D. Shaw. These are pretty much, as big as it gets, right, in this space.
Once, yes, of course.
Good experience, exposure, decided to come back to India, wanted to start something on their own. 2010 is when they started AlphaGrep. Started with a very low base of capital, small team. Along the way, expanded geographically and expanded into different kind of strategies. So today, when you look at the firm, we have, let's say, people in the company who are a combination of computer science grads, electrical engineering, maths majors, stat majors, right? So that's the kind of pedigree of people that we have gotten to either could be looking at the research aspect or two could be looking at, the technology infrastructure, right? Okay. To a large extent, the entire order management system, the risk management system has been built in-house. Okay, so this is not an off-the-shelf solution that we've taken from the market and, on which we're deploying. The entire solution, has been built in-house from scratch. Okay. And, only then can you have the right amount of controls, everything, at a firm level.
And you can tweak it whenever that's required.
You can tweak it, upgrade it.
Great. Yeah.
Right. And that's the reason, we have technologists who kind of looking at that. The other thing is that because we trade almost across 30 exchanges worldwide, right, we are pretty much operating 24/7. Right. So there's some of the other market which is operating at some point in time, and which means the infra has to be built in such a way that the infra can, kind of manage multiple asset classes, exposure to multiple countries. B, the risk management systems have to be robust enough, right, where it's technology, right, like something can break, something can give, right, which means that there have to be fail-safe measures at multiple levels. And three, we also have people across multiple offices around the world because you also have human oversight at all points of time.
No, absolutely. Valid point. Bhautik, let me also, we discussed about the methodology, we discussed about how processes work, but quant also known to be a black box. True. Right? That's what the theory says.
Yes,
Right? That's what we've learned in our textbooks. How do you see that, the transparency which retail investors might be looking for?
Yeah. So if you think about it, actually because of quant, you're not relying on a human judgment or a human emotion or a human bias, which is actually even more difficult to kind of, with transparency, explain to someone because it's happening in the human mind, right? In our case, every outcome that we have, okay, whether it's an asset allocation outcome or a stock selection outcome or a commodity selection outcome, is based on a certain logic, which is measurable, which is something that transparently anybody can look at the logic and say that, how did this outcome come? And the good part is that because it's kind of coded up into a logic, it's repeatable as well. Right? So that's where you get the discipline.
Well, although you've discussed some of the, the next question is on the engineer's part, right? We've discussed that in the past in the conversation earlier, but still, why do we need over 100 engineers in the mutual fund business?
There are actually more than 400 and not 100. So I'll tell you. Let me put it another way. When you look at our website also, of AlphaGrep, it actually mentions somewhere that it's actually a company which is built by engineers, first of all. Second thing is that we don't consider ourselves as just an investment management firm. We actually think of ourselves actually as a technology company.
Right.
Okay. So it's actually a technology company which is using the technology, using data, using algorithms to get certain outcomes in the market. Okay. And if it's a technology company, then we are obviously reliant on engineers, because they are the ones, who can effectively work with technology, right? Whether it's infra, whether it's coding, whether it's using AI. Like to give you an example on AI, considering we're a technology company, we're probably amongst the few first or very few early adopters of AI. Today, when you look at it, a lot of our research teams now extensively use AI. Okay. Another question that is generally asked to us is that will AI replace humans? Will AI start taking decisions on strategy and everything? At least for us, what we are seeing today is it has immense productivity gains. So today, what our research analyst maybe, without AI could have done a certain backtesting or testing or research, what would have taken a few hours is now happening in a matter of minutes. Okay. So productivity gains is something that we are seeing extensively in our research capabilities. Okay. Similar kind of productivity gains within our infra technology side, and some of the other peripheral departments as well. Okay. Another thing is that, and you can look this up, as a firm, what we've also done is, as part of our CSR at a group level, we've actually sponsored 2 AI labs. One is in IIT Madras, and the other is in IIIT Hyderabad, where again we are trying to help students out there kind of research around certain AI capabilities. So I'm just saying that that's the close linkage that the firm has to new age technology.
Absolutely. Now again, good that you brought about the AI part, because that's been in or around headlines for the past year or so, 12 to 18 months, I'll say that, and got up attention for the past 12 months. Algorithms has been in action for quite long time, because yes, it came to US first and then moved to India as part of the strategy. So can we say that algorithms are better at rebalancing?
I would say algorithms can do a few things. One is an algorithm, compared to a human mind, can process thousands of data points. Right? Two, because that logic is already fed in, it can process that information. Okay. And three, speed. Right? Today you have data, from both exchanges, right? And enough and more data which is available today, which may not have been accessible very easily a few years back. Right? So a lot of that data is available today. And any kind of data helps you extract inefficiencies from the market. So it, in our view, is just not about fundamental investing or the traditional way of investing, right? Where you only look at P&L, balance sheet, annual report. When you know for a matter of fact that markets are not just moving on fundamentals.
No, absolutely, it does make sense. And in fact, you said that you started off with the AIFs and the PMSs and asset management businesses across the globe. So does that sort of help you in framing the mutual fund strategy?
Uh,
Can we say that?
we can say that. So obviously the experience over the last 16 years of investing, not just in India, but global market helps. Dealing with multiple asset classes helps. To see models that are not just tried and tested and working in a single country, but working across multiple countries gives you a lot more confidence around the robustness of the model. So a lot of those experiences, background, helps the firm, right? And when we are doing that on a mutual fund, it gives us a lot more confidence when we are trying to, curate models for the mutual fund platform.
So can we say that it will also, the research that you have and the methodology that you've developed over the past 16 years, that will also transform the mutual fund industry once you bring all these models, in the open?
So let's look at the US. Okay, and the reason I look at the US is that ultimately, in some sense, whatever trend kind of happens in the US, it follows in India with some lag. So if you look at the US, passive is the simplest form of quant investing, right? Because there's no fund manager involved. There is a simplest logic which is kind of deciding on the portfolio. Now, passives in US probably around 30 years back was less than 5% of the AUM mutual fund industry there. 20 years back, that grew to, let's say, closer to 18-20%. And today, it's more than half the AUM there. Okay. The category which is growing at a very, very fast clip after passives in the US is actually quant investing. And when I say quant investing, this is active quant, wherein you have smart beta funds, multi-factor funds. When we look at the US, again, the category which is actually losing assets over the last 5 years are pure active funds, which are probably trying to give you market-like returns, because a lot of those funds are not able to outperform the market. Okay, and hence kind of losing assets out there. When you look at India today, okay, and you look at the split of AUM, bulk of our AUM still sits with active funds. Let's say around 15-20% sits with passives. The entire active quant space, in our view, is relatively blank.
Okay.
Or non-existent.
Exactly.
Okay. And with, technology changing, with access to data, and with more players who can potentially, use these capabilities and deploy strategies in this space, we think this blank space will get filled up over the next few years. So whether it's a domestic player or whether it's an international player, we think there'll be more people who will enter this space, right? And this space will get filled up.
So is it really a difficult task to explain what actually you do vis-a-vis compared to, let's say, a star fund manager approach?
See, considering people are used to investing in a certain way over the last, let's say, 15, 20, 25 years, right? It is a different process that somebody has to now trust or believe in, right? So there is a difference between, let's say, just relying on a star fund manager or a human versus now trusting a process. So there is a difference in that approach, right? So it's in some sense, it's a mindset change, which will take time. Having said that, what is giving us a lot of confidence is that when, we've been on the road for the last few weeks, meeting a lot of, MFDs, national distribution partners across the country. And wherever we've spoken about our firm capabilities, the approach to investing, about this first strategy, we are at least getting a lot of positive feedback. Okay. So in our view, it's a journey, right? The journey has just got started. We'll be happier if there are more and more people entering a similar space, where they'll be talking a similar language, right? Which ultimately helps, the space grow, right? So as long as there are more and more people doing it, space will grow, and there is going to be, a lot of education which is required, right? Around what happens out here, right? So that will happen.
Well, on that note, thank you so much, Bhautik, for joining me on this very podcast. And we wish you all the very best for your fund.
Thank you so much.
Thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.